Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're diving into everything investors need to know about Netflix, with the streaming TV giant's stock down big heading into its Q3 earnings release next week, as it awaits some challenges from Apple and Disney as well. But before we get into everything, I want to say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. Right off the bat, just so everyone knows, the firm is scheduled to report its third quarter financial results on Wednesday, October 16th. So that's next Wednesday. Netflix is one of the first big tech firms and hot names to report its Q3 results, with the big banks such as JP Morgan Chase unofficially kicking off earnings season next Tuesday. So yeah, they're reporting next Wednesday, October 16th. So here's what we know about Netflix going into their big, potentially, very important report next week. Netflix stock is down 25% since it reported its Q2 results in mid-July, and it's now down 21% over the last 12 months. This is by far the worst performance out of all the so-called FANG stocks, which is Facebook, Apple, Amazon, Google, and also Netflix, with Amazon the second worst performer over this stretch, which is down just 6% over the last 52 weeks. So Netflix is down over 21% over the last 12 months, with that next worst FANG stock as Amazon down just 6%. And we need to remember right off the bat that Netflix tumbled after it missed Q2 subscriber figures last quarter. So it's down 25% since July 17th when it reported its Q2 results, and subscribers are really what Wall Street and traders are going to continue to look at for Netflix for the foreseeable future. So Netflix added only 2.7 million paid memberships last quarter, which came well under Wall Street projections and its own forecast of 5 million. So Netflix executives expected 5 million subscriber additions. They added only 2.7 million. The stock obviously, people obviously reacted very poorly to that, and as I mentioned, the stock is down 25% since then. On top of that, the firm posted its first quarter-over-quarter subscriber, or quarter sequential from Q1 to Q2 subscriber decline in the U.S. since 2011. This is not totally out of the ordinary, though, for Netflix to miss its own subscriber forecast. So there was nothing completely crazy about it. It was just a big miss. It's come up far short of its own expectations before, and we should note that Netflix executives blamed part of the subscriber miss on its content slate at that time. More importantly, the company has followed up its previous 3 subscriber shortfalls with massive, roughly 1 million membership beats that next quarter. So, for example, Netflix added 5.5 million subscribers in the second quarter of 2018. So last summer, when it projected it would add 6.1 million. And then the firm added 6.1 million in the third quarter of 2008 to blow away its own 5.2 million forecast. So after a big miss Q2 of last year, they came back in the third quarter, added just over 6 million when they were calling for about 5.2. So a big beat after a miss. That's happened the last 3 times this has happened. So Wall Street and traders will be looking most likely for a major beat. And we should note that this is from their earnings release. Additionally, this is a quote, "Additionally, Q1 was so large for us. They added 9.6 million users in Q1. There may have been more pull forward effect than we realized. In prior quarters with over forecasts, we found that the underlying long-term growth was not affected. In staying focused on fundamentals of our business served us well." So obviously, company executives aren't going to just start saying, we're freaking out. They're going to always paint a bright, sunny picture. But as I mentioned, that big miss last quarter is not totally out of the norm, and that they have proven over the last 3 times they've missed their own estimates, those next 3 quarters, they came and blew away those estimates. So looking ahead, Netflix does expect to add 7 million paid users in the third quarter of 2019 to end the period with just under 159 million global subscribers. So they would end the quarter with 158.6 million global subscribers if they hit that 7 million addition figure that they're calling for. And overall, the company and company executives are confident that the broader industry trends will continue to work in their favor as more people cut the cord, especially internationally, which brings me to a broader look at Netflix and its competition. Netflix is currently the largest streaming platform in the world. They have just over 60 million subscribers in the US and around 92 million international subscribers. This is much larger than Amazon Prime. Even though we don't know those numbers officially, they last claimed to have over 100 million Prime users, but obviously a lot of those people are doing that mostly for delivery and shipping perks and different retail deals. Meanwhile, Hulu last reported 28 million users, so much smaller than Netflix. The only problem going forward for Netflix, well, not the only problem, but one of the big problems Netflix is facing is that it's just a streaming TV company, and it's about to face a much more crowded space with a few firms who are not only massive, they have huge diversified businesses. And the first one we're going to touch on real fast is Apple. Apple TV Plus is set to launch on November 1st, so in just a couple weeks, for $4.99 per month. And they're also offering anyone who bought a qualifying device, a new Apple device, will get a year free of Apple TV. And Apple TV Plus, just for a quick reference, will feature roughly 10 shows when it launches, including a space-era show called For All Mankind. One of the bigger shows they've been promoting is it's called The Morning Show. It's starring Steve Carell, Jennifer Aniston, and Reese Witherspoon. And then a post-apocalyptic drama called See. Some other shows as well. They're going to have A-list Hollywood stars both in front of and behind the camera over the next year. They're going to be rolling out more and more shows. And obviously, that small price tag of $4.99 per month is there because they don't have much content. As I mentioned, they're only going to have about 10 shows when they roll out, but they have been willing to pay a lot of money for the programming. They have reports said that they were spending about $15 million per episode to make See, which is that big show starring Jason Momoa. And we also know that Apple has about $200 billion in cash. They already pay a dividend, and they can just throw money at this for now as a way to make money in the long term off of their roughly 1 billion people who use their devices around the world. And then meanwhile, Disney Plus is set to debut on November 12th at $6.99 per month. And the company is coming in, obviously, with big names in the media landscape. It's Disney. So they have their classic Disney shows, or Disney movies, new Disney movies, Star Wars, Marvel, Pixar. They now own key Fox assets, a majority stake in Hulu. They also make billions at the box office. Their parks and resorts around the world. ESPN Plus is quickly growing. They're spending a lot of money to focus on UFC and soccer and other exclusive rights to get people joining that ESPN Plus service. And meanwhile, Netflix has a big content library, but they are just in the business of streaming TV, and their premium plans cost a lot more than both Apple TV Plus and Disney Plus. Their premium plan at the moment costs $15.99 per month, and that also is more expensive than HBO Go, which runs at $14.99 per month. And obviously, Amazon Prime offers a lot more than just Amazon Prime Video, and that costs $13 per month with all of those shipping and shopping perks. Netflix, though, is likely pleased that Apple and Disney are coming in at cheaper price points because they're not going to put that many people in a place where they have to then choose between, say, Netflix or Disney Plus or Apple TV. Maybe people just say, oh, it's $4.99. Why wouldn't I just try it out? Disney Plus might not even be necessarily that same user, where Disney Plus maybe will just be families and they just add that on. $7 a month is far cheaper than half of one movie ticket in most big cities. So that $7.99 or $6.99 per month might not even be a big deal. But in the long run, they are facing competition from companies that just have much more money, much more diversified businesses, and can afford to spend more money without really hurting their bottom lines going forward. And then we should also note that Wall Street and investors are pretty nervous because with all this new competition, which also is going to include Comcast's NBC Universal's new streaming service, which is set to roll out in the first quarter of 2020, analysts are worried that Netflix is losing some of its most watched shows. That includes The Office, Friends, Parks and Recreation over the next few years. The Office is currently, and this is from the most recent data from Nielsen, so this is a couple months old. This could have changed, but I highly doubt it, actually. The Office is currently Netflix's #1 show, and library programming in general, which includes TV reruns licensed from other studios, accounted for 72% of total viewing minutes last year for Netflix. So scary stuff if they're losing some of their most binge-worthy shows of those 25-minute comedy episodes where people just roll through a whole season without even noticing. And this is part of the reason why Netflix spent a bunch of money to land the streaming rights for Seinfeld going forward. As I mentioned, they lose The Office and Parks and Rec, which were two of their most watched shows. And Netflix will also have to continue, obviously, to spend lots of money to roll out hit movies and buzzworthy TV shows and continue to get those Emmy nominations to stand up against HBO and all of these other challengers going forward. And now I want to talk a little bit more of Netflix fundamentals before we look at a Q3 preview and then close out with some of my final thoughts. So Netflix stock currently sits at roughly $276 per share. This is through early Monday morning. This rests roughly 29% below its 52-week highs. On the bright side, Netflix has traded even lower than this over the last year, and sitting about 30% below its 52-week highs could give the stock plenty of room to run heading into Q3, and if it's able to impress investors in Wall Street, they could easily continue to climb going forward. And obviously that's all up in the air because who knows what they will do next week. And then in terms of valuation, Netflix isn't a value stock by any means. It's still a growth stock, but it's trading at 53 times forward 12-month Zacks earning estimates at the moment, which actually is well below its own 2-year median of 86. So some solid signs there. And obviously some of this is based on the fact that its stock price is down pretty significantly over the last year. For reference, the S&P 500 is currently trading at about 17 times forward earnings at the moment. And Amazon is actually trading just above Netflix at the moment as well. So Netflix, once again, is trading at 53 times forward 12-month Zacks earning estimates, which is below its own 2-year median, below Amazon, obviously far above the S&P 500, but that's the business they are working in now. And then Netflix is also trading at about 5 times forward sales estimates at the moment, which is also below its 2-year median of 7.3. And we can say that its valuation picture looks better than it has recently, but once again, that has a lot to do with the fact that its stock price is down pretty significantly over the last year. And investors and traders in Wall Street aren't super worried about its valuation picture at the moment. They still see it as a growth stock based on subscriber growth, especially international growth. What they are likely a little bit more concerned about is the company's growing debt load. They've continued to rack up debt in order to fund their content, which they need to continue to spend money on in order to compete. The firm had a negative cash flow last quarter, and they project their cash flow will be negative $3.5 billion for fiscal 2019. And then this is a quote from their earnings release last quarter. They think they'll slowly go more towards cash flow neutral, at least in the next several years. And then they say, in the meantime, quote, our plan is still to use high yield debt to fund our content investments as we did in April. So they're going to continue to take on debt to roll out more content, which some on Wall Street might be pretty nervous to see as that slowly racks up higher and higher. So now looking ahead to Q3, we're going to look ahead to Q3 and a bit beyond to give people a sense of what we can expect from Netflix. So looking ahead, our Zacks consensus estimates call for Netflix Q3 revenue to climb just over 31% from the year ago period to hit $5.25 billion. The key here is this would come in above Q2's growth and Q1's growth and Q4 of 2018's growth. So it would be bigger growth on the top line than it has for the last 3 quarters, so that's a positive sign. However, the preceding 3 periods did mark a slowdown from what had been an extended run of 30% or higher growth for a few years. So nothing crazy out of the norm. It'll just be a little bit better than the last 3 quarters if it is able to reach or surpass our estimates. And then overall for the full year fiscal 2019, revenue is projected to climb 28% to just over $20 billion, with 2020 then expected to come in 24% higher than our current year estimate to reach just over $25 billion. So 28% growth we're calling for this year, and then 24% growth that next year. These would mark slower expansions than 2018, 2017, and 2016, but these growth rates would hover around or be a little bit better than the growth rates that companies saw from between 2015 and 2012. So nothing crazy, just not the big top line growth people had been expecting over the last 3 years or so. And then at the bottom end of the income statement, Netflix adjusted Q3 earnings are projected to climb about 18% to reach $1.05 per share. And then overall fiscal Q19 or fiscal 2019's earnings per share for year is expected to climb over 21%, with fiscal 2020 expected to come in 77% higher there. So some bottom line growth in 2020 could maybe give people a boost to think that the company is headed in a right direction in terms of that bottom line. So now in closing out, Netflix is certainly a force in the larger streaming market. It's still one of the only pure play investments in the industry alongside Roku, which took a tumble recently based on some more competitive worries on that company's end. And as we've talked about, the company, Netflix, is still the biggest streaming player in the world. Netflix is also currently a Zacks ranked number 3 hold that has seen its Q3 earnings estimates trend heavily upward recently. However, its longer-term earnings trends have moved a bit in the wrong direction. And as I mentioned, all of the things we've talked about aren't going to necessarily matter for Netflix stock unless, well, I shouldn't say they won't matter. But the thing that's going to matter next week more than anything is its subscriber numbers. If it's, once again, the company is expecting to add 7 million users, 6.1 internationally, in around 800,000 in the U.S. And if they're able to beat that figure, well, they really almost need to beat that figure, or at least come in exactly at that 7 million figure, or people are going to start to get really worried because, as I mentioned, they don't miss back-to-back quarters. They do miss quarters, but that next quarter's after a miss is always followed up by a big beat. So you could say that that's management then just doing what they should be doing, and then just tempering their expectations, knowing most likely they should be able to beat that figure once again. So look for that figure next week, that 7 million subscriber number, that's where everyone on Wall Street is going to be looking. And if they're not able to beat that, the stock could continue to tumble. But if they are able to beat that, down 30%, maybe it has some room to run, as I mentioned, going forward. They'll also continue to look at their debt, and people will be asking questions on their earnings call about that. And then just some quick notes at the end. This is some thoughts I have on the company that are not completely novel ideas to me or anything like that, but that the idea within the next couple of quarters, certainly once we see what Apple TV Plus and Disney Plus do in the next, say, half a year or year, that some investors in Wall Street might be asking Netflix to look into their pricing, maybe if they're not as competitive compared to some of these other services. And then there also might be a call from some to add advertising, which the company has completely been against. And I would certainly be against that as well, seeing as that could alienate all of the people you've attracted for the last decade or so to this service. And then another thing that they might have to end up doing is, for at least their own content, their big TV shows, that they might have to not release them all at once. So, for instance, they spend a bunch of money promoting, rolling out Stranger Things, and then it just drops on one day. I believe it was a Friday this past season 3. They drop it on a Friday. Most people who are watching it are then either watching it all that Friday night or that opening weekend. You get a few articles on Monday, and then it's kind of just over with. They had all these different partnerships with Nike and other companies in the lead up. But what HBO is so good at, and what some of these other companies might do, where I think Disney's actually going to roll out their shows on a weekly basis, is that you have to have that kind of buzz. In some of these, in Netflix, you can drop whenever you want. So people might just buy Netflix for that month just for that show, say Ozarks or Stranger Things, where if you just get people used to it, where they roll out on a weekly basis or maybe twice a week or something like that, you might see Netflix be forced to do that in the long run, just in terms of a competitive standpoint of if HBO, they're still running a model like that, Disney Plus is going to run a model like that, maybe Netflix is forced to do that, or they continue along their path of we're the company that drops a whole season all at once. Everything you can just binge. So we'll have to see what goes on going forward. But in the meantime, all that really matters for Netflix is their subscriber figures next week, and then their subscriber estimates going forward to Q4, as they look to continue to grow outside of the United States, where their market is becoming much more saturated. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.